Why do some businesses thrive while others flounder? Often, the answer lies in their mastery of the language of business, accounting. Today, we delve into essential accounting concepts that not only illuminate the path to financial clarity but also empower businesses to make strategic decisions. First up, financial statements. Picture the balance sheet as a snapshot, capturing a company's financial position at a specific moment. It details assets such as cash and equipment, liabilities including loans, and equity like retained earnings. For instance, the balance sheet of company XYZ might show substantial assets due to recent equipment purchases balanced by liabilities from loans taken to finance these acquisitions. Moving on, the income statement or the profit and loss statement tells the story of a company's financial performance over time. It chronicles revenues from sales and subtracts expenses like salaries to compute the net income or loss. Consider company ABC, which might report high revenues from robust sales offset by the high cost of goods sold and operating expenses, culminating in the net income for the fiscal period. Now, let's explore the principle of double entry accounting. This method ensures every financial transaction impacts at least two accounts, maintaining the balance in the books. For example, if company XYZ purchases new equipment, it records a debit to increase the equipment account and a credit to decrease the cash account, keeping the accounts in harmony. Inventory valuation methods also play a pivotal role. With FIFO, or first in, first out, the oldest inventory items are sold first. Conversely, LIFO, or last in, first out, assumes the newest items are sold first. These methods can significantly affect the reported profit depending on cost fluctuations and inventory turnover. Next, consider depreciation and amortization. These processes allocate the cost of tangible and intangible assets over their useful lives. For example, straight-line depreciation would evenly spread the cost of a $10,000 machine over its 5-year life, affecting the company's financial reports and tax obligations. Lastly, financial ratios like the profit margin and current ratio offer quick insights into a company's financial health. The profit margin reveals how much profit is made from each dollar of revenue, while the current ratio assesses a company's ability to cover short-term obligations with short-term assets. To encapsulate understanding these accounting concepts, from balance sheets and income statements to depreciation and financial ratios, provides a clear lens through which businesses can view their financial landscapes. This knowledge is crucial for precise financial reporting and making informed decisions that drive business success. Through mastery of these concepts, businesses gain the financial acumen necessary to navigate the complexities of the economic world.